All right, hey everybody, welcome. Our topic for today is understanding the balance sheet of the Federal Reserve. Let's jump right in and be as efficient as we possibly can. I want to start out with a brief review of some things we've talked about over the last couple of class periods. If you'll remember, I've been trying to sort of give you the history of events that led up to and justified the creation of the Federal Reserve. One of the things we talked about was the free banking era, and if you'll remember, the free banking era ran from 1836 to 1863. 1836 because that's when the charter for the second central bank of the United States was allowed to lapse. Remember, from 1791 to 1811, that was the first central bank of the United States. Then we had a 5-year hiatus, and then from 1816 to 1836, we had the second central bank of the United States, and then under the presidency of Andrew Jackson, the charter lapsed and it was not renewed. And so from 1836 to 1863, we had both no central bank and also no federal laws around the banking system. And so we refer to this as the free banking era. Important, and I know we've said this before, but it's important because this was a window of time, an era in which we experimented with true laissez-faire capitalism when it comes to our banking system. So if you've ever wondered if we shouldn't have a Federal Reserve, or if you've ever wondered if we'd be better off without all these regulations, although we certainly have to make the disclaimer that the 1800s was a very different time than the era that we're living in, nevertheless, it is a nice lens through which we can view an episode when we did experiment with that type of a system, a very laissez-faire system. But if you'll remember, during the free banking era, we had three major problems. We had fairly frequent and massive bank failures, and I gave you some data here. Rolnick and Weber, who studied New York, Indiana, Minnesota, and Wisconsin, which were all free banking states. Remember, they looked at 709 free banks in those free banking states. They found that half of all banks failed, with a third of those unable to redeem their banknotes for gold or silver. 16% of the free banks in those states could not redeem their banknotes at all. In addition, free banks were short-lived relative to modern banks. 16% of all free banks failed within the first year. One of those banks would have been the Kirtland Safety Society Anti-Banking Company, which we discussed at length in class. And then we also note that the average life expectancy for banks was about 5 years. And we need to keep in mind that this is all pre-Glass-Steagall, which means there is no lender of last resort, there is no FDIC insurance, very few regulations. So if a bank failed, then that often meant that the depositors were out of luck. So that was one of the big hallmarks, one of the negative aspects and hallmarks of the free banking era. Second negative hallmark of the free banking era was fairly significant money supply fluctuations, and I've shown you the data here. Just look at the first two periods from 1834 to 1837. Money supply expands by 61%, and we get 28% inflation over that period. Then, if you'll remember right, on the heels of the dissolution of the Second Central Bank of the United States, and with inflation and land speculation problems, President Andrew Jackson enacted an executive order that required all public land purchases to be transacted in gold and silver. This has immediate negative consequences. So now the money supply shrinks by about 58%, and we get 35% deflation. So another one of just the hallmarks of the free banking era was a money supply that was largely completely out of control. As a result of the fairly frequent bank failures, right, average life expectancy of 5 years, 16% failing in the first year, and these wild fluctuations in the money supply, we also saw quite a bit of volatility in the business cycles, so macroeconomic volatility. Well, we move forward in time, and we also talked about the bank panic of 1907. I'm not going to review the entire web that was a problem during that time, but I will just point out, you remember that there was a copper magnate, his name was Augustus Hines from Butte, Montana, who tried to corner the market for United Copper. He failed spectacularly, which brought down his bank in Montana. It also caused a run on the bank in New York, the Mercantile National Bank, of which he was the president. So we had a run on that bank. And then C.W. Morse, who was on the board of directors of that bank, who also had official ties to at least 6 other banks. And he was chummy. He was a business associate with this guy, Charles Barney, who was the president of Knickerbocker Trust. So what happens is We get a bank run on the Mercantile National Bank, of which Hines is the president, and on the board of directors, Charles W. Morse. But then that bank run spreads, contagion catches on, and we get a full bank panic because of all the business connections of C.W. Morse. Ultimately, Knickerbocker Trust fails. This guy, Charles Barney, ends up committing suicide a few weeks later. Cutting to the chase, it was John Pierpont Morgan, J.P. Morgan, riding in on his figurative white steed, cobbling together a committee that provided not only oversight to make sure which banks were solvent and which banks were not, but it also effectively put together a syndicate of funding to rescue banks that needed rescuing, that should be rescued. This absolutely freaked America out. If you remember, I read a statement from a senator, a U.S. senator from Rhode Island, who said, look, we have to do something. We can't always count on Pierpont Morgan to rescue us when we get into distress. And in fact, we should make the point, there had been other bank panics before 1907 where we didn't get rescued. This was the one moment where we did, and thankfully we did. It would have been catastrophic had we not. But it became obvious to everybody that we needed to institutionalize this role of lender of last resort. We could not always count on a wealthy citizen with deep pockets and lots of political capital to come in and put together a committee and a syndicate. So we formed the Federal Reserve in the year 1913, which proved to be very prescient because if you'll notice here, J.P. Morgan died that same year. He actually died before the Federal Reserve was formally and officially created. So we get the Federal Reserve on December 23rd of 1913. But this led us to a larger discussion. If you remember, I said that I wanted to provide political cover for any of you on any point on the political spectrum to feel comfortable and to not feel embarrassed about supporting the existence of a Federal Reserve. I wanted to argue for why we should all be okay with the existence of a Federal Reserve. Now, to be sure, that's not me claiming that the Federal Reserve is flawless. That's not me stating that it couldn't be improved. That's not me stating that there aren't reasons for criticism. It's simply me saying we should have a Federal Reserve, and there are certain roles that it offers and serves that are very, very beneficial to all of us. So we asked this question: what services do we believe a government should provide, and can we agree on any of these? And I think almost everyone would agree that we benefit from a unified, nationally orchestrated, nationally deployed, and nationally overseen defense, that our military should largely be run and overseen and funded by the federal government. Very few people disagree with that. Many of you also would agree that, hey, there's a role for a federal government to help us build out infrastructure. And so I'm just showing here the national highway system, and so I hope it's obvious from the map that our federal government has been very active, and we have invested billions, probably trillions of taxpayer dollars over the last 100 years in building out infrastructure, which is why some historians make the statement that America did not build the U.S. interstate highway system. Rather, the U.S. interstate highway system built America, because it's very hard to have robust economic growth if you don't have a strong infrastructure supporting that from underneath. Many of you also mentioned that you want a unified, cohesive national policy deployed at the federal level, that when it comes to our relationships with India and with Russia and with China and with Canada and with Mexico and with Germany and with some of these other key countries around the world, that we do want to have a unified policy, one voice representing the entire country. We made the point in class that there's no way we win the Revolutionary War if we don't have an alliance with France. And so even from the outset of our country, we saw the need for a national single voice when it comes to foreign policy. Many of you would also say that we need to have a unified judicial system, a federally mandated or a federally overseen judicial system, largely to enforce contract rights, which I would say private property rights. But I think most people would say we also want a fairly effective judicial system to protect all of our human rights. Our Constitution enshrines certain rights that we argue to the world are unalienable rights, granted to us, I might add, by our Creator, which I think is significant. So most people agree that we definitely want some sort of judicial system, a legal system, an effective legal system to protect our rights. Well, this led me to a higher level discussion to ask the question, not specifically, so not what are the activities that we want the government to do, but from a higher level, a higher perspective, more 30,000 feet, when is government involvement tolerable? Now, we've said several times that our roots, our heritage from the founding of our nation have very strong libertarian leanings, that we were very wary, very leery of granting significant authority to a centralized government. And so we put very strict fences and parameters around that government. And yet, we still launched a centralized federal government, recognizing that we needed it. And so I wondered if maybe all of us, socialists, libertarians, perhaps not anarchists, but perhaps socialists and libertarians and everybody in between, could agree on these two statements. That we're okay with government involvement when the goal is to protect human and civil rights, life, liberty, property, the pursuit of happiness. Now, again, we will disagree. Respectful, intelligent, informed people will disagree on what exactly constitutes a human or a civil right. But if we do get consensus on what constitutes a right, then I wonder if we might all agree that there's a role for a centralized federal government to help us protect that right. Secondly, I wonder if we might agree that there could be a role for government when it comes to mitigating problems around externalities, extreme externalities. And I put up here my little matrix that I use to think about externalities. And remember, I think about activities from a micro level and I think about activities from a macro level. And if it's on a micro level and the costs to this activity outweigh the benefits, then very few people will do it. And if from a societal level, the same holds, that from a societal perspective, the costs outweigh the benefits, if that's the case, we don't want it done as a society. And because at the micro level, the costs outweigh the benefits, we won't get very much of it. In that case, we get an acceptable market-based outcome. We could say the same if the opposite holds. If at the individual level, the benefits outweigh the costs, people will do it. And likewise, if from a societal perspective, the benefits outweigh the costs, we should want it. Well, again, in that case, we get a pretty acceptable outcome from the market. Where we get problems are in these other two quadrants. If the benefits outweigh the costs for the individual, but from a societal level it's bad for us, then we're going to get too much of that activity, and we call that a negative externality. The poster child here is pollution. The benefits to the company outweigh the costs in the form of profits, but from a societal perspective, the pollution is very costly and might outweigh the benefits. In that case, we might all agree that there is a role for a federal government to come in and defend the best interests of the masses against the best interests of the greedy individual or corporation. Likewise, what if there's an activity where, from an individual perspective, the costs outweigh the benefits, but it's something that would be good for society? We would call this a positive externality. The poster child here would be a lighthouse. It benefits all of the fishermen and the entire community to have that lighthouse up on the hill, guiding the fishermen into the harbor at night. And yet, no single fisherman is going to go build that lighthouse because the costs far outweigh the benefits. So there may be some role for a government to tax the fishermen and the citizens that would also benefit from the lighthouse and to erect the lighthouse. So I wonder if we might all agree that when it comes to protecting human and civil rights and when it comes to mitigating problems around externalities, there may be a role for the federal government. Well, if you look at the roles of the Federal Reserve, and once we launch the Federal Reserve, these are the things that we've asked it to do. We've asked it to be a bank monitor, a regulator of the banks. We've asked it to serve as a lender of last resort, both institutionalizing and giving nearly infinitely deep pockets to the lender of last resort when we compare it to the ad hoc private lender of last resort that JP Morgan was. And then lastly, we have asked the Federal Reserve to balance what we refer to as the dual mandate, This dual mandate is to maintain full employment and to also maintain stable prices. Another way to think about that is the dual mandate is please help keep our economy revving and moving while at the same time preventing problematic levels of inflation. There was a third mandate originally when the Federal Reserve was created. The third mandate was to keep interest rates at moderate levels. However, the Federal Reserve has since largely abandoned that third mandate of keeping interest rates at moderate levels. They completely ignore that now, and that's why we simply call it the dual mandate of full employment and stable prices. Well, I would argue that though some of this is controversial, these are all positive externalities. That to have an entity that monitors the banks to keep the banking system healthy, that's a huge positive externality. It's good for society, but nobody on their own would have the resources or the power to do it. Similarly, serving as a lender of last resort is a massive positive externality. And while we did see one moment in history when one wealthy citizen did it, we've also seen many other moments in history where we needed it and it didn't happen. Why? Because very few individual citizens have the resources, the power, and the money and time to actually do it. So having the government do it serves a huge benefit to our society. I would make the same argument about the dual mandate, especially when it comes to stable prices. Having an entity that is in charge of producing and overseeing our money supply to make sure that we don't get inflation, that's wonderfully beneficial to society, but no single individual in the economy would be able to do it if we didn't have the government handle the function. So I believe the Federal Reserve is easily justifiable under the auspices and the argument that the Federal Reserve serves to mitigate some very important externality problems that frankly we suffered from for decades, for scores of years. Not having an effective bank monitor, not having a lender of last resort, not having an entity overseeing our money supply. These are precisely the problems that plagued us during the free banking system. Well, that's review. Forgive me for strolling down memory lane there for a few minutes, but I wanted to make sure we're all clear on that. Our goal now is to understand the Fed's balance sheet. And in just a second, I will show you the Federal Reserve balance sheet as it stands today as of the recording of this lecture. But before we get there, I have discovered that there are a few key preliminary points that if you will understand these, you will easily be able to understand the balance sheet of the Federal Reserve. If, however, you don't comprehend these points, you're going to really struggle to get your mind around the balance sheet of the Federal Reserve. Key point number one, the Federal Reserve does not actually produce dollar bills, the physical dollar bills made out of paper. Well, it's actually a specific type of cloth, but we'll call it paper. Those are not created by the Federal Reserve. Those are actually produced by the Bureau of Engraving and Printing, which falls under the purview and is a subsidiary of the Treasury Department. That's why if you notice, all of the bills have the insignia, or the signature, I should say, of the Secretary of the Treasury. In this case, it's John Snow, who preceded Hank Paulson, who preceded Tim Geithner, who preceded Jack Lew. So they're not created by the Federal Reserve. However, they are controlled by the Federal Reserve. It is the Federal Reserve that actually inserts the bills and takes the bills out of circulation. Third important preliminary point that you must understand. These things represent a liability in the eyes of the Federal Reserve. This is where it gets really buggy for most students. So here's $1. I want you to notice at the top it says Federal Reserve Note. By definition, by legal definition, what is a note? What is a promissory note? A note represents an IOU. you. So this piece of paper, if it's in your pocket, is an asset to you, and to everyone else in our economy, it's an asset. If you have a $1 bill, that's an asset, but in the eyes of the Federal Reserve, that represents a liability. Now, you might rightly ask, what do they owe me? If I have a $1 bill, what does the Federal Reserve owe me? Well, it turns out that they owe you precisely what is written on the face of this note. This is a Federal Reserve note, and they owe you $1. And that ought to be really buggy, because you're sitting there saying, wait a second, I have a $1 bill, and this $1 bill says that the Federal Reserve owes me $1. So what does that even mean? That means if you wanted, you could take your $1 bill to a Federal Reserve District Bank and you could say, I want to redeem this note. They would take that dollar and give you another dollar in return. Still feels super buggy, I know. But here's what you need to understand. If you go back to the 20s and 30s, these things actually did not say $1 at the bottom. It actually said redeemable for gold or silver. And I actually have a copy I'll bring to class of a silver dollar. And so what that meant was back in the 20s and 30s, if you went to the Federal Reserve and you redeemed your paper note, they would give you gold or silver in exchange for your $1. So that, if you realize that, that's going to help you understand why it's a liability in the eyes of the Federal Reserve. Because back in the 20s, if somebody showed up, they had to actually give gold or silver to that person. So it was a liability. Now, I thought you might be interested to know, even though the Federal Reserve doesn't create these things, the Federal Reserve is responsible for inserting these things into circulation. And there's actually a code on the front of each dollar bill, no matter what the denomination is, that tells you which district bank of the Federal Reserve put it into circulation. So you've read in the book about the fact that there are 12 district banks underneath the Federal Reserve umbrella. If you look on the front of this dollar bill, you can see this letter B, and it actually says right around the seal, Federal Reserve Bank of New York. Well, B corresponds to the number 2, and you can see the number 2 is written all over this bill. So B, second letter in the alphabet, corresponds to the Federal Reserve map, which is number 2, New York. So if you wanted to, right now you could pull out any dollar bill, any denomination, and on the face of it, it's going to have an alphanumeric code that will be consistent, A1, B2, C3, D4, and on and on. And that alphanumeric code will tell you exactly which Federal Reserve District Bank put that dollar bill or that $10 bill into circulation. Okay, fourth key point before we look at the Federal Reserve balance sheet is location matters. Where this dollar bill is determines what it is called on the balance sheet of the Federal Reserve. Specifically, if this dollar bill is sitting on a wooden pallet wrapped in plastic wrap in the basement of a Federal Reserve District Bank, it will not show up on their balance sheet. Think of it this way. What if I pulled out a piece of paper and I wrote on it, anyone who holds this piece of paper is entitled to $10 payable on demand from Colby Wright. And then I took that piece of paper, I folded it up, and I put it in my back pocket. Should that be a liability on my balance sheet? And the clear answer is no. That doesn't become a liability on my balance sheet until somebody else has it. So as long as the dollar bill is on the pallet in the basement of the Federal Reserve District Bank, it's not on the balance sheet at all. Now, if that dollar bill is claimed by a commercial bank, so if that dollar bill is now at a commercial bank, so it's in the vaults of Bank of America, or if it's upstairs in the bank vaults at the Federal Reserve and it is distinctly claimed by Bank of America, then we would call it a reserve. Those are called reserves. So if the dollar bill is at Bank of America or at Wells Fargo, or if it's on deposit at the Federal Reserve District Bank, not in the basement waiting to be put into circulation, but it's actually on deposit at the Federal Reserve District Bank, then we would call it a reserve, and that would show up on the Federal Reserve balance sheet, again, as a liability on the balance sheet of the Federal Reserve. If, however, that dollar bill is now put in an ATM machine and a customer of Bank of America goes and pulls out the dollar bill from the ATM, then it would be called currency in the hands of the public. Currency in the hands of the public. Now, most of the time, when you look at the balance sheet of the Federal Reserve, they don't break it out. They don't say reserves of banks and cash in the hands of the public. They'll just say Federal Reserve notes. Federal Reserve notes will be reserves in bank vaults and on deposit at the Federal Reserve, but it's got to be physical cash either in the vault of the bank or on deposit at the Federal Reserve, but the Federal Reserve notes will also include currency in the hands of the public. Last and final key preliminary point before we start looking at the balance sheet of the Federal Reserve, the Fed can create digital liabilities at will. And I will try to show you this in just a second. What can happen is the Federal Reserve in certain transactions, for instance, if the Federal Reserve decides to buy some U.S. Treasuries from Bank of America, in a matter of 5 or 6 keystrokes, they can actually create digital dollars. And I will try to show you how this happens in just a minute. That's very odd. It's unusual for a company to be able to create liabilities at will, but the Federal Reserve can do it. So let me just show you the balance sheet, and then we'll talk about how they change it. We'll talk about how they create liabilities at will. Let's notice a few things, and I'm recording this November of 2016, so this is the most recent Federal Reserve balance sheet that I have to show you. Notice that the total assets of the Federal Reserve as of the most recent reading are about $4.5 trillion. $4.5 trillion. Of the $4.5 trillion, $2.4 trillion is in the form of Treasury securities. So our Federal Reserve owns about $2.5 trillion worth of Treasury securities, which I should point out is over 10% of the total public debt outstanding. Well over 10%. Remember, the U.S. national debt is $19 trillion. Not all of that is debt in the hands of the public. But if you take the total national debt of roughly $19 trillion, the Federal Reserve owns well over 10% of all of that national debt. We're going to talk more about that. That's also a very bizarre relationship that we'll get to in subsequent lectures. Of the $4.5 trillion on their balance sheet, they also have about $1.7 trillion in the form of mortgage-backed securities. This is very unusual. If I took you back 20, 30, 40 years, you would have never seen a line item like that on the balance sheet of the Federal Reserve, and yet there it is today. Well, those are the primary assets on the balance sheet of the Federal Reserve. What are the primary liabilities? And you can see here are Federal Reserve notes, right? Those would be reserves at banks. Also, that would be cash in the hands of the public, $1.4 trillion. Notice that deposits, and these are going to be digital dollars, digital deposits, not physical currency. Digital deposits, $2.6 trillion. So far and away, the biggest liability on their balance sheet are digital dollars, which are still considered Federal Reserve notes, but they're not the physical Federal Reserve notes, so we just call them deposits. Notice that most of those deposits are held by other depository institutions. What does that mean? Banks. Wells Fargo, Zions Bank, Bank of America, SunTrust Bank. The Federal Reserve is called the banker's bank. This is where banks keep their deposits. They also have $375 billion on account from the federal government. Not only is the Federal Reserve the banker's bank, the Federal Reserve is also the U.S. government's bank. So, okay, that's a brief glimpse into the current balance sheet of the Federal Reserve. Our question is, how does the Fed change its balance sheet? Well, let's start with a very simple transaction. Let's assume that the Fed buys $10 million of Treasury securities from a primary market auction, and forgive my typo there. Let's come back for just a second. The Fed's going to buy $10 million of treasuries from the U.S. government in a primary market auction. So on the asset side, their treasury securities are going to go up by $10 million. On the liability side, they're going to, through nothing but a series of keystrokes, they're going to increase the deposits of the U.S. Treasury on account at the Federal Reserve by $10 million. And the U.S. government can then use those 10 million digital dollars to pay employees and to do whatever they need to do with those $10 million. So what will it look like? Well, I apologize for doing this to you, but we need to look at a couple T accounts. On the Federal Reserve side, it's going to debit its treasury securities by $10 million. So its assets are going up by $10 million. On the liability side, on the credit side, the deposits of the U.S. government are also going up $10 million. How does it look on the balance sheet of the U.S. government? Well, its deposits at the Fed, which would be an asset for the U.S. government, right? Any bank deposits that we have or the federal government has, all of those bank deposits are assets. So its assets in the form of deposits at the Fed are going up by $10 million. And its credits, meaning its liabilities, they're going to credit the liability side of the balance sheet, and it's going to go into the bonds payable section. So the bonds payable, the long-term debt on its balance sheet, would also go up by $10 million. So again, on the Federal Reserve balance sheet, securities right here on the assets would go up by $10 million. So notes, bonds, treasury notes and bonds would go up by $10 million. But also on the liability side, deposits of the U.S. government at the Federal Reserve would also go up by $10 million. Well, let's do a harder one. Let's assume that the Fed buys $10 million of treasuries from Bank of America. Bank of America then requests $1 million in cash, and then a customer withdraws $100 from a Bank of America ATM. Let's start with the first one. When the Federal Reserve buys the $10 million of Treasury securities from Bank of America, it is the exact same T account transaction as what you saw earlier. The assets, namely Treasury securities, go up by $10 million, and the liabilities, namely the deposits of Bank of America, go up by $10 million. Remember, the Federal Reserve is a bank, so deposits are a liability for the Federal Reserve. On Bank of America's balance sheet, its deposits at the Federal Reserve, which is an asset, Bank of America's deposits at the Fed represent an asset, it's money that's owed to them, that goes up by $10 million. But on the asset side as well, their Treasury securities go down by $10 million. So Bank of America is just transforming asset categories. They're transforming $10 million of Treasury securities into $10 million of deposits. So that's the first stage. Second stage, the Fed transfers $1 million of physical cash to Bank of America. So now they're taking one of those wooden pallets from the basement, putting it on an armored truck, and sending it over to Bank of America. So what does this mean on the Fed's balance sheet? All they're doing is transforming liabilities. Specifically, they're reducing the deposits of Bank of America by $1 million, and they're replacing it with Federal Reserve notes of $1 million. On the Bank of America side, they're just transforming assets. Now, they're reducing their deposits at the Fed, and they're replacing it with cash reserves. That's the second stage. Third stage, a customer withdraws $100 from a Bank of America ATM. Let's think about the customer first. Well, the customer is now reducing their deposits at Bank of America by $100, and they're replacing it with $100 of cash. How does this look for Bank of America? Well, they're reducing their liabilities. Specifically, they now owe $100 less in the form of customer deposits, but they also have $100 less in cash reserves. So that's a nice example, a three-stage example of how balance sheet changes and manipulations work when it comes to the Federal Reserve. Now, the interesting part of the lecture. Now that we know a little bit about the balance sheet of the Federal Reserve, I want to use the balance sheet of the Federal Reserve, specifically changes in the balance sheet of the Federal Reserve, to understand where the pressure points were during the financial crisis of 2008. Think of it this way. Here was the balance sheet of the Federal Reserve in June of 2008, right before, as we might say in order to avoid crass language, right before the organic fertilizer hit the ceiling-mounted air conditioning unit. Right before all of that went down, here's what the balance sheet of the Federal Reserve looked like. Notice, total assets of $894 billion. So going into the crisis, the total balance sheet of the Federal Reserve was less than $1 trillion. Most of that was in the form of U.S. Treasury securities. We had about $500 billion of Treasury securities. So this was a very normal balance sheet of the Federal Reserve. Then, what happened during the financial crisis was, if we think about our economy and we think about our financial system as a dam, if you will, there were massive leaks that sprung in the dam. And there was more than just one. And you'll be able to see where these leaks in the dam popped up by looking at the Federal Reserve balance sheet. I'm going to now show you the Federal Reserve balance sheet just 6 months later. So you just saw the balance sheet of the Federal Reserve in June of 2008, total assets of about $900 billion. Here's what it looked like in December of 2008. And to try to make this a little bit more efficient, I've gone ahead and identified the 4 significant changes to the Federal Reserve balance sheet. First big change, which I haven't highlighted, but we need to make sure we understand, the Federal Reserve balance sheet doubled in size from June to December. Remember, in December of 2008, total assets were $894 billion. Call it $900 billion. By December, they were up to $2.2 trillion. Where were the big changes? Well, let's start right here. There's something called the Term Auction Credit Facility. That one increased, so this shows you the change from a year earlier. That number increased by $430 billion from the previous year. So that number, the Term Auction Credit Facility, is bigger by over $400 billion. I'll tell you what that is in just a second. Second main pressure point here, the net portfolio holdings of Commercial Paper Funding Facility, LLC. Notice, by the end of the year, that's at $331 billion, a net change from 1 year earlier of $331 billion. So that's brand new. That was something created during the crisis. Notice the change in other assets, up $566 billion from 1 year earlier. We've got to talk about what that was. And then also notice that their holding of Treasury securities was down by $300 billion from a year earlier. So these were the 4 main pressure points: Term Auction Credit Facility, Commercial Paper Funding Facility, other assets, and U.S. Treasury Holdings. So here's how I think about it. The dam is literally starting to burst. Ben Bernanke starts sticking his fingers and his toes everywhere he can in the dam to try to maintain the structural integrity to just keep the thing intact. So what was the first one? The Term Auction Credit Facility. These were intermediate term loans to commercial banks. Now, they already had a lending program to extend credit to banks. They had discount lending. This was completely different from discount lending because, remember, discount lending is intended to be very short term, to just help banks meet the reserve requirement. What this was all about, this Term Auction Credit Facility, These were intended to be intermediate term loans to give banks longer and more stable liquidity. $400 billion worth of intermediate term loans for the purpose of stability and liquidity was handed out to commercial banks during the financial crisis. That is huge. Remember, the entire balance sheet of the Federal Reserve was $900 billion going into the crisis. Just in the commercial banking space alone, the Federal Reserve provided $400 billion of explicit relief. Explicit relief, $400 billion. Well, this makes sense. We've talked at length about what caused the financial crisis and where the pain was. The epicenter was real estate, but the very next area affected by the earthquake was banks, commercial banks. This is where we were hemorrhaging, and it's precisely the place where you cannot afford to hemorrhage. This is the heart of your financial system. You cannot tolerate large-scale cardiac arrest, and so we put the defibrillator on them and give them $400 billion. Next, the commercial paper funding facility, $300 billion. We talked earlier about what happened. As this began to grow in magnitude, you remember when Lehman Brothers went bankrupt, they defaulted on some of their commercial paper. Commercial paper is just the corporate analog of T-bills. Super short-term borrowing. Typically, only the safest borrowers are allowed to be active in the commercial paper market. When Lehman Brothers defaulted on its commercial paper, it sent shockwaves through the entire commercial paper market. Now, all of a sudden, investors are spooked. Nobody wants to invest in commercial paper because nobody can trust any of the borrowers. This is a huge problem. Since the commercial paper market is the corporate analog to Treasury bills, very short-term corporate debt, the yields, the interest rates are very low. Some of America's very best borrowers, some of America's top corporations depend on continuing issuance of commercial paper to fund their operations. Because instead of issuing a 30-year note or a 30-year bond with a high interest rate, you can just roll over commercial paper as needed at lower rates. So when that market came to a grinding halt, literally the entire economic system of the U.S. was in the balance. And so the Federal Reserve decides that if nobody else is going to buy commercial paper, they will step in and do it. How much? $300 billion. And I remind you, that's enormous relative to the total size of the balance sheet going into the crisis, which was only $900 billion. But if you'll notice, one of the biggest increases on the Federal Reserve balance sheet was in other assets. Other assets increased by over $500 billion. If you read the footnotes, most of the increases in the other assets were these things called central bank liquidity swaps. Let me explain to you what was happening. Because of the U.S. financial system crisis, it triggered a global dollar crisis. What happened was there was no dollar-denominated assets that were trading. And because there were no dollar-denominated assets trading, and also because everybody was spooked and freaked out and didn't want to trade, everybody was hoarding U.S. dollars. So people were hoarding U.S. dollars, and they were hoarding U.S. dollar-denominated assets. The markets just came to a grinding halt, as demonstrated by the problems in the commercial paper market. This is a perfect example. The commercial paper market seizes up, so there's no commercial paper being bought and sold. So that means there's no dollars flowing. This is devastating to the global trade markets. Because there are no dollars flowing, because people are hoarding their dollars, they're afraid to give them to anybody else because they're worried about defaults. So because there's a global dollar crisis, now international trade starts to come to a grinding halt. And why is it that global trade comes to a halt? It's because most transactions are dollar denominated. Most transactions are dollar denominated, and yet the dollars are scarce. People are hoarding their dollars. So here's what happened. the U.S. Federal Reserve Bank offered central bank liquidity swaps to central banks around the world. Here's a very common example. The U.S. Federal Reserve would send $10 million to the Japanese central bank. The Japanese central bank would send the equivalent amount of Japanese yen to the U.S. Federal Reserve Bank. So it's nothing more than a currency swap. With the agreement, initially at the outset, there is an agreement that several weeks or several months later, we're just going to reverse the transaction. So now Japan will send the dollars back to the U.S. and the U.S. will send the yen back to Japan. All this was an attempt by the Federal Reserve to flood the international markets through the central banks with as many dollars as they needed to allow international transactions to be executed and consummated. So, we have the term auction credit facility, $400 billion, commercial paper funding facility, $300 billion, central bank liquidity swaps, $500 billion. Add all that up. That's $1.2 trillion of explicit support into the markets. New explicit relief and support. Going into the crisis, our entire balance sheet was only $900 billion. We have just, in 6 months, provided $1.2 trillion of support, but that wasn't the only support. We also reduced our Treasury Holdings by about $300 billion. Now, what's the reason for this? It's crisis. It is full-on panic. People are hoarding dollars, and there is what we call a flight to safety. And what are the safe haven assets? Gold, for sure, and U.S. Treasuries. But the problem is nobody wants to sell their U.S. Treasuries because everybody's freaking out. So all there is immense buying pressure for U.S. Treasuries. But that's problematic. So there was a massive shock to demand. Massive shock to demand. So what happens when demand gets shocked? Prices shoot through the roof and yields go down. In fact, would you be interested to know that at one point during the financial crisis, the yield on U.S. Treasury bills went negative? The yield went negative. Think about that. People were paying the federal government just to hang on to their money and keep it safe. That's how bad it got. So the Federal Reserve decided to come in on the sell side. They decided to serve the role of a market maker to make sure that all those people trying to buy treasuries could actually do it. So again, there's the balance sheet of the Federal Reserve before the crisis, $900 billion total. There it is after the crisis. And you can see all the ways that the Federal Reserve tried to stick its finger and toes to plug up the dam. We sold a whole bunch of treasuries to try to relieve all that buy pressure during the flight to safety. We offered $400 billion of intermediate term loans to banks to provide liquidity and stability near the epicenter of the crisis. We intervened in the commercial paper market, which had seized to a halt largely because of the default of Lehman Brothers, and we started buying, the Federal Reserve started buying that commercial paper to get the market working again. And then we provided those central bank liquidity swaps to the tune of $550 billion, roughly speaking, central bank liquidity swaps to provide dollars to central banks around the globe so that international trade could continue to happen. So what did that mean? Our balance sheet went from $900 billion to $2.3 trillion in the space of 6 months. But remember, there must be an offsetting liability change. What was the offsetting liability change? Federal Reserve notes, but more than Federal Reserve notes, it was deposits of banks. So there was a lot more money on deposit at the Federal Reserve from other commercial banks in the United States. Well, we'll have more to say about this, but what I want to end with today is, what does our balance sheet look like right now as of the recording of this lecture? Well, as of the recording of this lecture, the Federal Reserve balance sheet has changed dramatically once again. Notice, now the total balance sheet is at $4.4 trillion. So we went from $900 billion before the crisis to $2.3 trillion during the crisis to $4.5 trillion at the end of 2016. Now notice, a lot of these pressure points during the crisis have been healed. You will see there is no such thing as the term auction credit facility on today's balance sheet. That problem, and remember that was money lent to banks to give them liquidity and stability, that problem is gone. Commercial banks are stable, they are liquid, that's a good thing. You'll also notice that there is no commercial paper funding facility. Our government stepped in to provide liquidity in the commercial paper market during a time of crisis. We're no longer there. That's gone, and that's a good thing. Other assets are back down to normal levels of $20 billion, nowhere near where we were during the crisis of $600 billion. Remember, this was largely central bank liquidity swaps to provide dollars to the world so that international trade could continue. That problem is done. There is no global dollar shortage. So the good thing is all of these pressure points in the dam have been patched. That's awesome. But I want you to notice how our balance sheet has changed. During the crisis, we had $476 billion of U.S. Treasuries. Today, we have $2.4 trillion. We have $2.4 trillion of U.S. Treasuries on the balance sheet of the Federal Reserve. That is more than 2 times the entire size of the balance sheet before the crisis. Also notice, we now have $1.7 trillion of mortgage-backed securities on the balance sheet of the Federal Reserve. Nowhere during the crisis, nowhere before the crisis will you find mortgage-backed securities. This is entirely new post-crisis. So our Federal Reserve has mushroomed its balance sheet from $900 billion to $4.5 trillion by buying a ton, actually that's way too generic, by buying $2.5 trillion of U.S. Treasuries and $1.7 trillion of mortgage-backed securities. Well, why did they do it? Why did they buy all of those Treasury securities and all those mortgage-backed securities? This is another one of those moments where we draw the constellations in the sky. We've painted stars on the canvas. Now let's use it to make sense of the world. If you'll remember, in the bond market, you have demand and supply, and we talked about what drives demand. What I'm telling you is, over the last 7 or 8 years, since the financial crisis, our Federal Reserve has been buying treasuries and mortgage-backed securities like crazy. That's a massive shock to demand. How much? Well, we've bought roughly $3 trillion in total. We started the crisis with a balance sheet of $900 billion. Now it's at $4.5 trillion. So we've bought about $3 trillion worth of bonds. So we've shocked the demand to the right. That has raised the prices of Treasury securities and mortgage-backed securities. And we know that prices and yields have an inverse relation. So by driving those prices up, our Federal Reserve has driven the yields down. And why has the Federal Reserve felt compelled to drive the yields down? Remember the dual mandate: full employment, stable prices. Since the crisis, they've been trying to get us to full employment. How do you get us to full employment? You have to supercharge GDP. Y equals C plus I plus G plus NX. So by pushing down yields, they've been pushing up C. And by pushing down yields, they've been pushing up I. And some would argue that it's mission accomplished. Finally, in the year 2016, we see unemployment of 4.9%, down from a peak of 10%. So here's what's been happening. Our Federal Reserve has been blowing up its balance sheet by $3.5 trillion for the purpose of driving prices up and yields down to try to spur on C and I to try to get GDP revved up to get us to full employment. But there should be one question that lingers. If our Federal Reserve has added $3.5 trillion to its balance sheet on the asset side, that means it's added $3.5 trillion on the liability side, which means they've either put $3.5 trillion more dollars of physical currency into the economy, or they've put $3.5 trillion more of digital currency into the economy, or some combination of both. So I hope there's a very pressing question that you're thinking about right now. If we have inserted $3.5 trillion of either physical or digital currency into the economy, how can it possibly be the case that we have not created inflation? Stay tuned.